The countdown has begun. We've got a wave of public offerings that we know by now. We're going to have three companies, $3 trillion companies, raise billions of dollars. I guess the question is, what happens afterwards? Well, let's find out. Here's iCapital's Chief Investment Strategist, Sonali Basak. And I guess the questions are focused right now with respect to Anthropic, OpenAI, and SpaceX. The valuations are out of this world, no pun intended. And can they get away with it, for lack of a better, thinking about this?
You can see them go public at, say, the valuations that they're trying to seek, but then what happens after that is the bigger question. People forget that the IPO is one moment in time. That's all it is. You see SpaceX go first, and then by the time Anthropic starts to go, you get into earnings season pretty quickly. And what kind of volatility are we going to see? Right. The second quick point I'd make about this is that of the investors that I speak to, and many of them are currently invested today in OpenAI, Anthropic, and SpaceX, the worry about the growth rate slowing in public markets. You probably see this the most when you look at Snowflake in comparison to Databricks. Databricks is growing really, really fast. It's about a $120 billion company, almost $130 billion company. Snowflake is much less than that.
Is the company growing or the valuation growing? Because those could be two different things.
The valuation is growing, and the run rate is also expected to surpass that of a Snowflake when you look at the revenue too. But I will say this, why is that? In the private markets, you don't have that quarterly, mark to market, if you will, for their earnings. You do, but you do have those private investors throwing more money in quickly in order to do deals, acquisitions, grow at a competitive pace that we just don't know yet for these companies what that's going to look like.
One of the big question marks, I think, has been the tokenization, right? Tokens. And so you have Anthropic that did $1 billion in revenue, then it's 30 billion, and now the numbers are, through the roof in terms of expectations. A lot of that's come because of the token model.
Yep.
The question, though, is, can they keep this going when you have companies saying, we got to slow it down? Uber put their folks on a $1,500 budget.
The Amazon leaderboard starting to go away. This is the topic to focus on. I applaud you for doing it, because people in America need to understand token economics now if you want to understand the business models of these companies that are the companies of the future. The history of software shows you that usage-based pricing gives way to seat-based pricing. It has been the case for software over a long period of time that the buyers end up getting more control because the biggest buyers are saying, no, we want to pay a more blanket price based on how many employees are using it. Token costs, as we know, have been rising astronomically as agentic AI has been using those tokens, burning them quickly. We think that there's going to be, a little bit of a buyer's strike, as we're calling it now.
Because they went crazy. These enterprises got them. They love them. Everyone's gone nuts, and now they're kind of looking around like, hey, you know what? Have you seen a bill for this thing, right?
Yeah. I mean, listen, this is the perfect thing to look at here. Everyone in Silicon Valley, all the investors in Silicon Valley are talking now about that token cost decline and how much it will decline, because realistically speaking, what it means is you're going to have to see a lot more buyers to offset that decline in token costs.
Right.
On the offset, remember, these costs are also being subsidized too. So are we going to see, this is the big debate, are we actually going to see a tick up or a plateau in those costs at some point?
Let's talk about the next big themes out there, because one of the fun things I've been having fun with is what's the next $1 trillion company. People have some interesting names they've thrown up there. Artificial intelligence, general intelligence, AGI, and big data. How's that going to change the game?
So we were talking about Snowflake and Databricks a little earlier. The reason is because you look at those three big IPOs this year, and what's next? Databricks is one of the ones that's next in line, and it is a much smaller company when you look at the market value. And so it's hard to find that next $1 trillion company in the near term. It might take a while, realistically speaking. Big data, people forget. Not only is this really important in terms of the companies today that are focusing on AI, the valuations that you're getting for companies that can get big data right. Fun fact for you, second most profitable deal in history for Blackstone was around Refinitiv.
Really?
Very quick turn.
Really?
People don't know that.
Wow.
And so big data is an area that's perhaps less, eye-popping on the face of it. But if you don't have good data, you don't have good AI. And really cleaning up data is no easy task. Artificial general intelligence, we just don't know when we're going to get there.
Right. And then, of course, I guess, I don't know, ASI, it's still the jury's out. I hope we don't get there, but I don't know if it's inevitable. I want to ask you about private credit.
Sure.
Last time we talked about this, you got a little, you roughed me up a little bit. So when I saw this slide in your amazing presentation that private wealth clients are shifting away, are we okay? I mean, is the coast clear on this private credit stuff?
Listen, I'll explain the dynamics. I think you want to talk about what's happening with the redemptions versus inflows.
Right.
We should talk about that when we get to that chart. But over here, yeah, this is our flow of funds data at ICapital. You're seeing in the first quarter, 18% was private credit, very different than what you saw, but it's still inflows, isn't it? That you're seeing people still buying.
Right.
You're also seeing here private equity take a bigger and bigger share recently, which is not surprising. People are getting all excited about these IPOs.
Right.
Really, what you should have said is, well, wait a minute, you want to get in even at lower valuations, but still, you can see why people are excited about growth equity with this IPO market coming back. There's something structural here. When interest rates go down, private equity gets relatively more interesting. But now we're in that higher for longer interest rate. I would expect that private credit number to get bigger again.
Okay, so you're okay. It's just a function of more demand for private equity in this environment.
Correct.
Not an indictment on private credit.
Correct. So yes, the alternatives generally.
Let's talk about alts in general then, because a lot of people, a couple of years ago, really, you heard more and more folks come on the air and talk about them, and still a lot of the viewers are not sure what this means, what it is.
So alternatives, big, broad asset class. I think we should stick to just private market alternatives for a minute here, because even within that, people look at private equity, private credit. There's also infrastructure. There's also real estate. A lot of people talk about those nearly 14,000 companies that are in private markets. Let me give you another number. About 86% of all companies with revenue over $100 million, 86% are private.
Right.
And so what is happening there? It's creating an entire ecosystem around financing those companies. And so more and more is happening in these private markets, and therefore a lot of these industries are finding ways to broaden access to them.
Good. Before I let you go, I want to circle back to what's happening. They had the jobs report today. Inflation's a big issue. Of course, inflation, growth faster than wage growth, is sort of a red flag. What are you anticipating here? You've already talked about hiring for longer a couple of times during this interview.
Yeah, the wage growth has been something that has been more muted. We think that the K-shaped economy is still going to feel the pressure of that because inflation is going to stay sticky at this point in time. We don't think this year that the Fed is going to be able to cut rates, especially with where inflation is.
Will they be forced to hike?
I think that will be difficult to do at this juncture. There's a lot of assets that are tied to those borrowing costs. Mortgage rates are not sustainable where they are. You know that, Charles.
Yeah. No, I'm with you. I don't think they're hike either. And we'll see what happens in the second half of the year. Iran conflict comes to an end. I think a lot of things change fairly quickly. It's supply chain issues notwithstanding.
Yeah.
Sonali, thank you very much.
Thank you,
That was
Charles.
fantastic. Appreciate it.